hear Reed and talk about tapering as if it's it's driving everything. And maybe the debt markets do drive a lot of behavior. Now, let me ask the panelists question. I'm going to put Andrew on the spot and write down the panel. If I told you for sure that interest rate, that the treasuries are going to go up by 75 basis points between now and January 1st, how would that affect your real estate investment activity?
You know, what I'd hope it do is affect pricing. I'm not sure it would affect our activity in the context of the point of having to use leverage, not use leverage. I think we use leverage to enhance returns. We're a total return investor. But if you ever got a bid from us, and anyone in the room who has, it doesn't require us to use leverage. We have plenty of equity. And so I think we will move in and out of that. I will tell you our general prospects on interest rates would suggest that we went a lot more fixed rate in our overall $22 billion of assets we have under management today. So we have views that rates will move. But I would say, at least from a pure investment, forget about what it may do to the existing portfolio and value, we would be big proponents of interest rates going up a lot, actually, because we don't need to use leverage.
Yvonne?
So I agree in terms of pricing being what the focus on. But in terms of what our managers are doing, we've seen trends in terms of them trying to lock in some long-term great rates on a fixed basis. And so if you were talking about between now and the end of the year, I really don't see that you will see much movement there, because our managers, and particularly because of coming out of the crisis, where the focus, of course, was on how everyone treated their debt and who was more proactive and who was more risk averse, and all of these have kind of changed everyone's temperament as to how they deal with debt, just to use it on an optimal basis only. And what we've seen with our managers is that they've taken the position that they have long-term planning with respect to debt, and so they've already kind of transitioned to try to lock in the best rate they can.
So you think there's more discipline on behalf of your managers today with respect to debt and structuring their portfolios?
Well, absolutely. Not only on the manager's part, but the market is actually forcing it as well, because I'm in some commingled funds that have caps of 65% or 75%, and that's not what the managers can get, and that's not what the managers are structuring today. So there's a lot of natural tensions keeping, debt.
Kevin, same question. Dodd or Jamie Dimon came down and said 75 basis points between now and the